Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media, generally related to three different topics: wealth building, commodities, and/or financial topics. So we're going to dive right in there, take a look, see what people are sharing on social media, and I'll interject my financial opinions as we go through it. If you want to follow me, it's at _finance. And if you want to join our community, finding-value.com, where I dive deeper into all of these topics, subjects, looking for potential investment opportunities and sharing those opportunities with everyone in the community. We just recently had a Sunday question and answer session um, covering some things that are now posted on the website. In fact, I'm taping this before the Q&A session, so I can't go into details of exactly what we cover. But that will be posted, and you can see that on the website. We do have a coupon code special. Special is the coupon code. If you'd like to join, 50% off the monthly membership for 1 month only, and a larger discount on the yearly membership if anyone wants to sign up or move into the yearly membership. So starting with myself, we've got some ratios. I like the ratios. I approach the markets with a three-pillar approach. The three pillars are ratios, market conditions, and technical analysis. The reason it's those three is technical analysis is an unbiased way to look at charts and come to a conclusion of something that could potentially occur. It's not 100% probability, but it is a high enough probability if you start stacking a lot of these things together. Um, we can say 1,000 charts across the market will tell you a decent picture. So you're looking from within the market to figure out what you think the market is doing. And it's based off of how people are positioning in the positions. And these patterns, they repeat over and over. And we can use that on longer time frames to see the fundamentals of the sector. Ratios are just a way to tell if something's cheap or expensive. You can also do technical analysis on ratios as well. And it also paints a picture of where you're at in these cycles. So if a financial asset, for instance, Google, Facebook, I guess Meta now, Alphabet, whatever you want to call it, you can price them against hard assets and you can see what's outperforming. That is part of the cycle. And market conditions are the cycles. So you could say with certainty that financial assets are expensive to hard assets at this time. And you could also use technical analysis to say, yep, it is turning. The cycle is turning. And then you can identify roughly where you're at in the cycle. You can't do it precisely, but you can do it roughly. We're roughly in this general location. Hard assets are cheap. Financial assets are expensive. We are maybe at the beginning of this all rotating from financial assets to hard assets, and then you can use the ratios, you can use technical analysis, you can use all of those things to paint a picture based off of the positioning that people are taking in the markets. It cuts out all of the bias with listening to experts. It cuts out the bias of news and what they want you to listen to and know versus the raw data and you drawing your own conclusions from the raw data. So what we're going over here is some of the ratios. And I'll make comments about what I think it's potentially saying. So this is US oil or oil price divided by the SPX or S&P 500. I've got a falling wedge here. The way that you get these wedges is you get a lot of support at these wedges here, where you get turning points. So you get a turning point, turning point, turning point, turning point, and turning point. Potential turning point, I should say here. This is really, really strong. The resistance support level is. Conversely, up at top, I cut through this top here. And some people say, well, you're not supposed to cut through. BS. So what we're looking for is we're looking for a contraction from high, a lower, a lower, and then maybe we get a lower here, and we're coming right into the corner where a potential large move could materialize. If we break out, and in my opinion, we're going to break to the upside based off of the market conditions and the positioning in the market that I look at, we could see a huge outperformance of oil versus financial assets. And yes, it's going to be a twofold hit. One, US oil going up, and two, the S&P 500 most likely falling. It may not occur simultaneously. For instance, we might not see oil go up the same time that the S&P goes down, um, if depending on how fast the S&P 500 goes down. So the big question mark, in my opinion, it's not that oil is cheap and the S&P 500 is expensive. It's not that we're squeezing into this corner here, ready to explode to the upside. A lot of people will ask, when? When is it going to happen? I don't know the exact when. I can't tell you exactly when this will go. So what I can do is I can position in this at favorable valuations and wait for this to occur. So some people say, well, I don't want to wait. It's like, fine, don't make a lot of money then. I don't know. I don't know how to answer that question necessarily, because in order to make copious amounts of money, you have to buy things when they are in corners like this, and one asset is ridiculously priced, US oil in this case. And I'll show you other pieces of information of why I think oil is ridiculously priced. We can also look at the fractals. The fractals are repeating patterns that occur over time. Before these big moves, you can always see these little fractals. Basically, you go from a downtrend, it pauses for a little bit, and then we get a big move. We go from a downtrend, it pauses for a little bit. You can see the fractal, the way that it moved in this little area here is the same in all three instances. They're pretty dang close. And that was before these big moves. So what do you think is going to occur next if we have fractal big move, and then we've got this is another fractal here, I guess, big move, fractal, and then if we break the downtrend line in this corner, we could have a very, very big move. So from this chart, we can conclude a couple of different things. We're squeezing into a corner, number one. We're getting tighter squeezed. Number two, we're at a very low ratio for oil being cheap against financial assets, which is the S&P 500. And three, we've got similar fractals of each of these before the takeoffs. Check, check, and check. Moving into gold versus oil. This is another thing that I look at, and I look at history going back to the 1800s. Now, this one doesn't go back to the 1800s, it goes back to 1952. Buying oil, when you get below this ratio here, and I usually do gold to oil ratio, not oil to gold. But this looks easier for people to understand, as oil is going to outperform gold. Squeeze into a corner of a falling wedge, breakout, squeeze of another corner, falling wedge. And we haven't broken out yet. And it could go down and do a false breakdown before going higher. That's the question mark. What happens over the next 6 months? But coming from valuation levels this cheap, which is the second cheapest time in the history, going back probably to the 1800s that we've been in, is today. So if I were to draw a normal distribution curve, and you look at the tails of the distribution curve, we would be at the tail of the cheapest oil has ever been. And then you would say, well, what is my probability of making money if I buy oil the second cheapest time it's ever been in history? I'd say it's probably pretty high. Now, the only thing that would take this is if oil was going to go to the wayside, which I don't think that's the case. So we have a falling wedge, break out of the falling wedge, and we have another falling wedge that we haven't broken out of. And I can buy oil the second cheapest time in the history of the market of the oil to gold ratio. I love it. I absolutely love it. This is oil just priced in dollars. You can see that the circle is where I think we're located. That circle is a breakout of the consolidation and a retest. Breakout of the consolidation. Now, are we done retesting? I don't know. I don't know the short-term market movements, but what I can tell you is it's the second cheapest time in history priced in gold. Now, could there still be further movement down. Could we do a double bottom down here? It's possible. Yeah, it's totally possible. But buying it at the second cheapest time in history, I'm all in, man. I like that. Oh, and this is the fractal on the right hand side of this move here overlaid on top of it. If you guys want to see the similarities of where I think we're at in the cycle. The next portion of the cycle is when the dollar drops. So the lower interest rates, the dollar will drop. That's exactly what Besant and Trump are trying to do. And then all dollar denominated assets go up. Oil's priced in dollars. Boom, there we go. Also, the debt situation that we're in will also ensure that the dollar will most likely get weaker and they'll have to inflate their way out of their situation. This is Dow Jones versus crude oil. This is the last bull market into 1999. Well, I should say the last bear market for oil top. And then the bull market is when we compressed back down for oil. So this is 1999 to 2008. There's similarities here from the top of 2020. And I think we are where the orange circle is. So we came on up in a bear market for oil, a bull market for Dow Jones. We pulled on back. And if you look at the fractal, the upper, how this thing peaked, you can see that we're similar with a shoulder, head, shoulder playing out right now. And that the circle is roughly where we're at. This guy here is this guy down here. So we have this little pause, move up, and then we have a one last kind of return move before this dives down. The ramifications here is this here is the third cheapest time when crude oil is priced against Dow Jones. You can see this is a little bit cheaper in 99, but we're pretty dang close. And if this compresses back down, guys, I've been playing with artificial intelligence on free cash flow yields for some of these companies. Oh my God. It is insane what they could be making out in the future if this does come back down. And with the fractal looking like this, it looks pretty dang similar to history. So coming down to palladium, and we're doing a bunch of different um, ratios here. So this is palladium priced in dollars. You basically have three stages. You have resistance, breakout. We have another area where we hit a couple resistance a couple times, breakout, retest, boom, gone. And now we're back using it as support. So right now in 2024, I would say that's similar to 2003, perhaps. So we're real early, and this could move around. Maybe it's doing this type of move right in this area, but it's a good time to, I think, look at palladium and keep it on the radar. Just keep it on the radar. Looking at the ratios of palladium, this is palladium versus silver. You can see that buying silver at the top here was the best, one of the best entry points for silver. 2001, 2000, and this year was 2020. And then coming back down, silver outperformed all the way to the bottom of 2008. And we are doing that move right now. So it's palladium going down and silver going up is that combination. Do I think we're going to go all the way back down here? Totally possible. Where this could fall all the way back down to 19 or 17 or whatever it is down here, 20 general area. That would be a great time to potentially grab a bunch of palladium. Now, this cycle, I put a sine wave or cosine wave on it, same thing. Maybe it peaks at like late 2020s, early 2030s. The ultimate bottom here was 2009. I purchased this. If you guys want to know, I purchased it in this general area here, rode it all the way up and swapped it, not into silver. Silver, the premium shot up when I was going to do it, so I went into platinum. So here is the palladium platinum, and that's exactly where I swapped it at. I got 3 ounces, a little less than 3 ounces is what I got of platinum when I swapped out my palladium. So 1 ounce palladium, a little bit less than 3 ounces platinum. And I bought it in 2009 and 2005, this area in here and this area in here. And I didn't know palladium that well. I didn't know the ratios as well. I just saw it was really cheap because I was watching it from 2004 onward. And I was like, oh, I'll just grab some. And then when everything crashed, I was like, oh, I'll grab some more palladium. It's super cheap. It was like 100, upper 100s, low 200s in pricing at that time. That rode it all the way up and swapped into platinum. Now I'm riding the platinum train downward. Hopefully, we can get the ratio back to this area where it says buy palladium again. And then buy gold versus palladium. Buy palladium down here. Gold, it was cheap in 2001, 2000. It was also cheap here in 2020, 2021. And then we came all the way back down for gold outperforming palladium to a buy palladium area that is looking better and better. Now, some people say, well, what does gold have to do with palladium? It has nothing to do with it. Gold used to be our money system, guys. Gold used to be the gold standard, what we would price things against, backed our dollar, et cetera, et cetera. So could it get cheaper? It very well could. But I think we're in a general location where palladium's looking a lot better against gold. This is gold in general, so I put gold as the top here. So gold versus platinum, you can see gold's been outperforming platinum. Now, there's a couple things that I want to talk about here. Buying gold 2000, 2008, 9, great location. It's outperformed platinum ever since 2008. 2008, 9 was the bottom of the commodity bull market. What this is telling us is that we aren't done yet and we haven't shifted yet into the commodity bull market. We are still waiting for that complete shift. Now, am I going to buy platinum up here? Yes, I will. Yes, I will. So I still like platinum over gold. Here, even though gold is outperforming platinum at this exact moment, I would be accumulating platinum for the potential turn. This is a market condition. When the market condition turns into inflationary environment with interest rates going up, that's when the turn will occur. Now, are we going to get a recession first? That's when gold outperforms. That's kind of what we're going through right now. We are probably in a slowdown, recession, something's occurring right now where gold is outperforming platinum. And that market condition hasn't changed yet. Doesn't mean I wouldn't buy it though. I'd buy it all up in here because we don't know when the exact moment it will turn. This is silver versus gold. So gold divided by silver. So buy silver when it's up here, buy gold when it's cheap down here. So obviously in the 70s, gold was a good idea to buy because silver was so overpriced. So silver was expensive in relationship to gold. Gold would have been the obvious winner. In 1991, you want to get into silver up here and then ride it back down. And then you just swap silver, swap gold, swap silver, swap gold, swap. And right now we're in go long silver area. Usually when you fall like this and then you get these like this bounce up like that, generally that is an indication that we could fall to the downside. Silver outperforming gold. This is buy palladium, buy gold. It's the opposite of the other one that we just looked at. But some people like swapping these back and forth. But gold was cheap in 2001. Gold was cheap here recently. And then we're getting to an area where palladium is going to be favorable if we get to those areas. If you ride this entire move, this is a 10-year move, you went from, let's just call it 4.5 right through here, all the way down to less than 0.5. That is 9 times your return there. 9. Then if you ride it back up on this 2001 upward, you did it again. So you went from 0.4. So let's just do some math on this just for the heck of it. You put some money in palladium. Oh man, I'd have to know the price of palladium. We can pull it up here. I'm interested because these are some pretty big moves. Palladium's one of those that are pretty good. So back in 1991, this is the bottom here. God, look at that. It's such a great entry point. So this price, if you got in, let's say it's $85. So let's just put you have $5,000 divided by 85. Let's say you put in 60 ounces, roughly 5,000 bucks. Okay, so let's go through this together. You've got 60 ounces that you purchased when the ratio was up here, roughly speaking. You're riding 60 ounces and you swap it at a ratio of, let's just say you get in at 0.5, which is not the bottom of the bottom, but you swapped in around 0.5. So that means that 60 ounces, you want to divide it by zero point 0.5, you have 120 ounces of gold. So you ride it all the way up, and let's say you got lucky and swapped it out at 4, which is possible. So you went and you got up around 4, and you didn't get the peak, but you sold it on the way back down at around 4. So that means that you have 120 ounces and you multiply it by 4, and now you have 480 ounces of palladium. You rode it all the way back down, coming all the way down, and then you swapped it again at 1. Let's just call it 1. So you did a 1-to-1 swap. You have 480 ounces of gold. Right now, the price is roughly 3,000. You made from $5,000. You turned 5 grand from 1990 into $1.44 million of swapping this back and forth from 1990 to 2025. So 2025 minus 1991, I think it was, 34 years. So if you started working at 22 years old, you'd be 56, 5 grand into $1.44 million if you deployed this. Now, what's your risk? The risk is like nothing. It's very low risk because you're trading metals outside of the system. That's all I'm going to say. Very good strategy. And that's only playing palladium and gold. That's not even taking into consideration playing other metals, which would have vastly increased that return. So here's gold futures coming on up. There we are breaking out in US dollar terms, and that looks fantastic. Here's silver. Let's go over silver real quick. So silver's got the cup and handle. Boom, boom. That thing's ready to just absolutely rip. $350 an ounce projection on a logarithmic move. We've got silver versus gold. It's squeezing into a corner when you look at it from this perspective. A potential breakout, similar to what US oil and the SPX is doing here. Very similar on a different time frame. Silver versus platinum. We can see platinum is incredibly cheap. It's just been going up and up and up. And we'll see if we get a turn here. It might even go up and get into some ridiculous level and then rapidly unwind at some point where platinum could rapidly outperform everything. We're not there yet. We're getting close. And then here is buy palladium, buy silver. Obviously, silver was good here, and we are outperforming palladium. And I think I did platinum too. So here's platinum. This is the last of the ratio charts. We can see a huge squeeze occurring. So we're building energy, building energy, building energy, similar to what it did in 1997 through 2000. 3-year build. This one here started in 2020. And we got a 5-year build. The longer it builds, the more pressure it basically creates for a potential breakout. So that looks good. This is platinum versus gold. You can see we're really cheap compared to history. I think this is the cheapest it's ever been in history in relationship to gold. Huge opportunity. We've got buy palladium, buy platinum. I did my swap here of palladium into platinum, and it's been outperforming. We're at a 1-to-1 relationship. This is looking pretty good, and maybe a potential breakout and come back up to this area here. And that's going to take probably a decade. So, or less. I mean, we'll see. This one here, it went from 2001. You could have swapped it in 2006 or 2008. So it took 5, 6, 7 years up to maybe close to 10 years for the ultimate peak. So if we bottomed in 2020, I would expect the peak to maybe occur in 2030. That would be my guess. And then here's buy silver, buy platinum. You can see that platinum's really cheap to silver, and then we've got a falling wedge with a 3-hump consolidation. This actually looks perfect to go long in platinum. Now, some people would ask, should I swap my silver for platinum? I have not, but if I didn't have any platinum and I had a boatload of silver, I probably would swap some of it if it were me, just to have that exposure. But keep in mind, silver's got that big cup and handle, and that thing could unload too. So it's a balancing act. It's such a beautiful chart here. This is 1899, 1906, and 1929. Very similar looking to what we've got going on today of 01, 08, 2020, and 2025. Keep in mind the S&P 500 outperforms when gold outperforms platinum. So it's still going up. Gold is still outperforming platinum, but when is that turn going to occur? Once that occurs, you're going to get an inflationary period. And that inflation is probably going to cause havoc on the stock market because it's going to increase interest rates. Wyckoff applied to NVIDIA. And so people are trying to find topping patterns in NVIDIA, in the S&P 500. It's based off the valuations and the patterns here that a lot of people think we're in a huge bubble, and I think we are too. Once this rolls over, I think commodities are going to go ballistic. So that's where I'm looking, commodities. And that's all I've got for today, guys. So we're going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. I do the ratios with other things too. You can price a stock divided by the asset and then chart it. And that can also give you information about some of the opportunities in the market and how the equity is lining up against the commodity that it sells. That generally bottoms in like a falling wedge or something like that. Most of the time we're double bottoms, and then it works its way on up and outperforms the commodity when the commodity goes up. That's your leverage to the commodity. But that's all I've got for today, guys. So we'll catch you next time. This is Finding Value.